Is Costco Wholesale Group too high to buy? Looking at the company from the perspective of price to sales, you can see that typically the long-term price to sales has been 0.53 times sales or lower. The company is currently trading at a blended price to sales of 0.92, almost twice as high as typically normal. But you should also recognize that the company has been selling at these high values for 3 or 4 years now. Watch this video in its entirety to see if Costco truly is too high to buy, or if there are other ways to look at how to value this company. Hello everybody, this is Chuck Carnevale, co-founder of Fast Graphs, the Fundamentals Analyzer software tool, aka Mr. Valuation. I did not get a video out last week, and I want to start today by saying I want to thank everybody who showed concern and worry. As many of you may not know, I live in the Tampa Bay area, Florida, and had a horrible week last week where we were hit with Hurricane Ian, and some parts of Florida were really damaged very badly. We were very fortunate that we came out of it. We did lose power for a couple days, but nobody was hurt in our immediate friends and family. So I do want to thank you for your well wishes and your concerns. And let's put our prayers out to all the people that are still suffering after that devastating hurricane. But anyway, as a result, I didn't get a video out last week. And so what I'm going to do here is a kind of a bonus. Today I'm going to do a subscriber request video. I'm going to cover 6 of the top companies that you, the subscribers, has asked me to look at recently. As many of you may know, I'm not doing subscriber requests anymore because I was just simply inundated. But I thought since I didn't get a video out last week, I'd go ahead and give you a video this week with some subscriber requests, some interesting companies that you asked to see. So I'm going to go over them. I want to point out I have not researched all these companies thoroughly. So I don't really have what I would call a real learned opinion of them. I'm going to look at what the numbers show. I'm going to look at them from the standpoint of the fundamentals, earnings, cash flows, dividends, things like that. And I'll let you decide whether or not these stocks are research worthy at their current valuations or not. It's all up to you, because remember, there is no substitute for comprehensive research and due diligence. So let's go ahead and get started in looking at the portfolio. Now, the 6 companies that you asked to see was Advanced Micro Devices, Costco Wholesale, Digital Realty, the Real Estate Investment Trust, International Paper, National Storage Affiliates Trust, which I wasn't familiar with at all, and Qualcomm. And so I did create a view for these companies here to kind of just give you a first glance, and I'm going to do them in alphabetical order. Now, 5 of the 6 are investment-grade companies. National Storage Affiliates does not have a credit rating, and I'll cover that one, as I get to it. But otherwise, these are all very high-quality companies and generally very, very popular. Now, all of them pay a dividend except the very first one on the list here, Advanced Micro Devices. So let's go ahead and look at it first. Now, one thing I want to point out, this is a major competitor of Intel. And I want you to notice that if you look at this company historically going back to 2002, really the price has gone nowhere in all those years. From 2002, you could have bought the stock at $17 a share. All the way out here to 2018, even into 2020, before, you were still seeing the stock trading at exactly or very close to the same price. You can also see that earnings have been negative in many of those years. The company wasn't doing very well. However, one of the beauties of Fast Graphs is that you can shorten the time frame and adjust to the earnings growth. So let's drop this down to an 8-year graph. I'm actually going to drop it down to a 7-year graph. And what you're going to see here is for the last 7 years, this company has really kind of got its mojo on, if you will. And the company's been growing at an unbelievable rate of about 60% a year. But I want you to always understand where those growth rates come from as I do these videos. Now, the normal PE ratio and the fair value PE ratio, using Peter Lynch's PE ratio equal to growth rate, applied to this company. It actually looked like this company was fairly valued for all those years. When you take a longer term perspective on this company, it looks like it was dramatically overvalued, where you're looking at a PE that was closer to, we'll call it 15 to 20, 18.9 precisely. Now, the question is, what is real for this company? Now, as I look forward, I see that growth rates are expected to be 11% and 14% for the next 2 years. If I go into forecasting calculators, we're expecting 18% over the next couple of years, but that includes this year, which includes a 56% expectation for fiscal year 2022, which is a massive number. But going forward, we're only looking at 11 and 14% numbers. So I want you to make sure that you understand that, you can only buy the future, not the past. But there is some justification in the last 4 or 5 years for how the valuations were so high. And I would even argue there's some justification why the valuation has gone down so much, simply because it can't and isn't expected to sustain a 64% growth rate going forward. And remember, this is purely a growth opportunity. In other words, the company does not pay a dividend. It is A- rated, and it does have very little debt, and it's very competitive, and it's become very competitive here recently. But once again, when I'm looking forward, if I look at the long-term growth expectation, it is expected to be very, very high. They seem to have, got the analysts' attention right now. So you could argue very strongly, I think, that advanced micro devices, given these current valuations, could be a very attractive long-term growth stock opportunity here that could generate, significant rates of return. I don't like using the normal multiple of a 60 times earnings multiple because I think that's completely unrealistic. If I, went through here the normal multiples, this company is typically traded at very high multiples. It is growing faster now. That could be the case. But again, I think I would look at this company at maybe somewhere near a 20 multiple would be about as high as I would want to go. Let's look at the company a couple of different ways for you. Again, I want to span this out to a 15-year growth rate because I do want you to be aware of the fact that this company has had some trouble making money in the past. So I want to look at it from a standpoint of cash flow. The company's been struggling with cash flow. Cash flow growth recently has been very, very strong. That's, something in its favor. It's, kind of a hot commodity now. If I look at the stock on a price to EBITDA basis, and again, I go to a longer term time view here, there's been some erratic growth and failure in EBITDA. There were negative years included in this, in this time frame. I do want to end up by looking at sales. The company's sales have been really very, very, in fact, they were dropping from 2005 all the way through into the pandemic, if you will, into the COVID pandemic. And then they've just started to rise here recently. So we've just now seen sales beginning to rise. They've, really kind of become very competitive with Intel, which is struggling in its own right now. So remember, this is a tech company. It's been very, very cyclical in the past. If I look at analyst scorecard, the analyst scorecard is decent. The analysts have been getting the company right for about the last 7 or 8 years now. So that does mean that if I'm looking at these forecasting calculators and looking at, the number of analysts that are reporting adjusted, well, I looked at it wrong. Let's look at earnings analyst scorecard. I was looking at sales. It's still very, very good for the last several years. So, maybe these analysts have it right. That would mean the company could be a very attractive looking investment, for the future right now, if you're not investing for income or dividends. And, it's a high quality company. It has, very good financials. Those of you who are subscribers, I would suggest that you go into the financials. I'm not going to do it for sake of brevity here. I would go into the fiscal fitness, and I would be focusing on the last 7 or 8 years. That's really what I think you need to focus on with this company now. And you could run it through that screen, those of you who are premium subscribers to the tool. All right, so, my take is, and bottom line is, I don't think 65% growth is sustainable. I'm not even sure I agree with 40% growth. One thing I will do real quickly is check Yahoo estimates and see what they think for long-term growth. They think it's going to be about 25% over the next 5 years. So again, there is some reason to be skeptical. You could go into the custom forecasting calculator if you would like to, and you go ahead and hit the custom calculator. And you could, change this to, let's say, 25%. They said 26, but this is close enough. And this would still look like a very attractive growth opportunity. So that's my take on advanced micro devices. It has a very long history of not making any money. It's really begun growing and been able to put together 4 or 5 years of really fast growth, which really does change the valuation dynamic significantly if you're looking at the most recent years. And by the way, I generally do consider the most recent years the most important years. So let's go ahead and move on. Let's go to Costco, which is the one I featured in the beginning. Now, Costco, from an operating earnings point of view, has grown the company at a double-digit rates, about 11% a year. You can see the company has paid special dividends on numerous occasions. That's why you see this very big spike in the dividend line here. And you can see that, they paid sometimes, like $6 a share, $7 or $8 a share here. I'd have to look up those real numbers, but you can see the company has shared their prosperity with shareholders. And I think part of it, as a result, this company has commanded about a 25-ish. The actual number comes out to 26, but notice when I change time frames that multiple changes, okay, because it's always an ish number. But I'm going to say a 25-ish multiple has been typical for this company on earnings. Earnings are expected to continue to grow at about the same rate that they've been growing. And this looks like a dividend cut, but that's not. That's because they just recently paid a special dividend. Long-term growth is expected to be about 13%, but the company is trading at a 35 multiple. Okay, so what I'm suggesting to you is even though the company typically trades at a very high multiple, I believe it's overvalued. It has been for the last 3 or 4 years. Love the company. Can't argue with it. Don't like the valuation. It's that simple. From a cash flow point of view, you get a little better valuation perspective. I think because of the special dividends, the company has generally traded at about 14 or 15, times cash flow, as you can see historically. For the last 3, 4, 5 years, it's been trading at a much higher price to cash flow. And again, currently the blended price to cash flow is over 23. So I love the company. I just think it's selling at a very high valuation now. If I look at it from a standpoint of EBITDA, I get the same perspective. It's normally trades at about 13 times EBITDA. It's currently trading at 21 times EBITDA. So, I'd be cautious on buying the stock now. I'm not sure I'd be a seller if I owned it for the long run. I might be willing to ride out the storm because, I do expect the market to continue to value this company high. On a price to sales basis, though, it also looks very highly valued. Buying hold is my philosophy, but I do want investors to recognize that they're dealing in very high valuations on this company right now. It's been, especially considering what's been going on in the market, it's something that you might want to pay attention to. Now, when I go into digital realty, this is a real estate investment trust, so the most appropriate way to look at this is using what they call FFO, funds from operations. And then you can also look at, as some analysts prefer and some investors, adjusted funds from operations, which I don't like this one as much because it's different. Most companies do it differently. The FFO number is very standardized, but both of them give you a very similar view of the company. Now, this company does yield almost 5% in dividends. The market has liked to trade, this company at a little premium. Digital Realty is one of the, considered one of the really quality REITs. It has some of the highest growth of any REIT out there. It's averaged, just under 10%, 9.43%. But again, you can see the effects coming out of COVID. The stock got very, very overvalued. And now in this recent market malaise we've been in, the stock now has moved into reasonable territory. It doesn't offer me a great margin of safety at this point unless you're willing to look at it from the normal multiple basis. But from my view, I like this company. I'm long the company, but I bought it when it was much more reasonably priced back in here. I'm going to continue to hold it. I woulda, coulda, shoulda sold it here, but I didn't because, again, I do believe in long-term ownership. But I think the company looks, very, very good going forward with a dividend yield of almost 5%. Now, the market is very, very strong today. So let's, real quickly take a look at, how the market's pricing it today. We'll go into Yahoo Finance. It's up just under 2% today. Some stocks are up 4 and 5% today. But, be careful what they call a dead cat bounce. But anyway, there's Digital Realty, which is a REIT. I'm going to go ahead and skip International Paper and go to NSA because it's another REIT. and I want to stay in the FFO case. Again, this is a very young company. Now, I want to use this example to talk about something. We have been in a very strong bull market coming out of the Great Recession of '08 and '09. Stock valuations have been very, very high. Interest rates have been very low. So I do want you to at least be considerate of the fact that this was a perfect market to get valuation, and they came out, they're only been a public company since 2016. So, price has been normally, it's been trading around a 20 multiple, more or less. You can currently buy it at a 15 multiple, but for my money, I would consider it now fairly valued for the first time almost since it's been a public company. And it is expected to continue to grow, and it is expected to offer double-digit rates of return with a dividend yield of 5.29% and growing. And once again, we'll take a quick look and see how the market's valuing it today. It's up 2% as well, 1.9, 9%. So it is attractive now. From an analyst scorecard point of view, they have a very excellent analyst scorecard. Once again, I suggest you go in and do the financials and go ahead and look at the fiscal fitness. And you can also, by the way, go ahead and look through it. When you're looking for that, if you see things that are aberrant, you can go into the company's financial statement if you're a premium subscriber, and you can look at the income statement, the balance sheet, and the cash flow statements, and especially the income statement and the cash flow statement to look to see if there's anything, funny going on, in the company. So anyway, that's National Storage and Affiliates, which is a specialized REIT. Let's go back into the company. And one thing I hadn't looked at here, because I'm not real familiar with this one, as I mentioned, I'm not sure exactly what they specialize in. So the company invests in self-storage. Apparently, that's kind of a hot commodity now. So you might want to, you want to do your research on this one. But the valuation does look, based on the proper metric, it does look like it's entered reasonable valuation for the first time. So let's go back into the order that we should. Let's go ahead and look at International Paper. I'm looking at operating cash flow here. International Paper is offering a dividend yield of just under 6%. That's statistically very attractive. They did cut their dividend during the Great Recession, but then quickly, raised it again. So they have a decent dividend record, I want to point out. My problem with this company is the cyclical nature of the business. You can see earnings are all over the place. Their payout ratios have been very, very high when they weren't earning well, but cash flows have generally covered their dividend. If you were ever going to buy International Paper or buy it, today would probably be a good time to buy it. You're looking at a PE of 7.53. The stock, again, yields 5.84%. From a forecasting calculator point of view, it's expected for the next couple of years at least to grow pretty fast. But now, again, I want you to use the tool correctly. We're seeing 13.43%. However, that includes a 42% growth rate this year, followed by only 2 and 8% in the years going forward. So you want to, if you're thinking about the future, you want to be cautious about what might happen in the future. The analysts have a very dismal record of getting this company's earnings right on either a 1 or a 2 year forecasting basis. And, common sense would suggest the reason for that is when you look at the company's historical operating results. Very, very erratic, very, very inconsistent, very hard, apparently, for analysts to forecast. From a sales point of view, their sales growth has been very flat, almost, only 1%. So it does look inexpensive on the basis of price to sales. And it may be a good speculation to buy it at these prices and maybe hold it for an intermediate term. I just find it very, very difficult to own this long term. You can see that back in March of 2002, the company traded at $41 a share, and today it's 31.7. So obviously now it was way overvalued during that time frame. But even if you bought it in the throes of the Great Recession and held it to today, you would make double-digit rates of return. But the key is valuation matters, and it matters a lot. So you always want to pay attention to that. And then last but not least on the list, we want to take a look at Qualcomm. Qualcomm went through about 5 or 6 years here of very poor earnings growth. As you can see, they had negative earning growth for 5 years in a row. But then they started, like we saw with AMD, they started to get their mojo back. And if you shorten the time frame on this company and look at it, their growth has been pretty strong for the last couple of years. The analyst scorecard has been good, but not great. But, generally speaking, the analysts have gotten this company right. So that makes me feel, reasonably good about the forecast. But once again, you have to go and do your own due diligence. From a standpoint of looking at this company from other metrics, again, it's recently been, getting their kind of, getting some real good growth going on. But again, growth is expected to slow down from here going forward. So this could be an aberration that you want to be on the lookout for. When you're investing in the future, you want to be looking at what these potential growth rates. And again, with fast graphs, you can go and check other estimates. Like, if you look at what Yahoo thinks, the analysts that report to Yahoo think the company's going to grow at 7.6%. Our long-term growth rate is 15.45 from first call, so somewhere between 7 and 15%. If you expect the company to continue to grow, notwithstanding that there are 2 years ahead of us that might be flat, but the low valuation, the high margin of safety with this A-rated company, I think make it look like a very attractive investment. You can get a 2.66% dividend yield on the company now, earnings yield of very, very attractive at 11%. Looking at it from a standpoint of how's the market treating it today, it's up over 4% today. That to me is a function of pent-up demand. So, as I said, I haven't been doing customer requests. I'm not real familiar with, many of the companies I've covered here. But anyway, this has been Chuck Carnevale saying I hope you enjoyed this video. It's kind of my way of just, apologizing for not getting a video out last week, although I spent a lot of time in the dark and a lot of time cleaning up around my place. It was just, a really horrible storm that went through, and it did cause some death, and it caused a lot of property damage to a lot of people south of us. And our, prayers go out to those people, hope for everything for a speedy recovery. Everything's kind of recovered up in the Tampa Bay area right now, so we feel very blessed for that. Again, I want to thank you all for watching. If you enjoyed this video, go ahead and give me a like, and ring the bell, subscribe to the channel if you haven't already, and for goodness sake, how you could be an investor in this stock market and not be a subscriber to Fast Graphs is beyond me. I couldn't possibly consider investing in stocks today without the beauty and power and benefit that Fast Graphs offers. Thanks for watching.